This reflects the market structure rather than any theory about intent. When the CME futures complex went offline, but spot metals continued the trading, the price action exposed a degree of interdependency between the two venues and the interdependency in metals of the bullion market, the bullion dealers, to trade both venues. So on the left-hand side, you see silver futures. Silver futures. On the right-hand side, you see a representation of spot, not the true spot market, but CFDs, which trade out of Europe. The left-hand side, when the futures closed, they closed. The right-hand side, the market, the silver market, had a very deep dive immediately thereafter. And then it reorganized itself, and it seems to be normalizing. But the deep dive after the gray line is what I'm talking about here. It'll be more obvious in gold, but I want to leave silver up here for the moment. If you review the charts from this window, you will notice a pronounced dip in gold during the outage. This is silver. Let's go to gold since I'm talking about it because it's worse. All right. The simple interpretation is structural. A meaningful share of the incremental buying in precious metals originates from the future side, while a meaningful share of incremental selling flows through the spot and OTC market. When the futures market suddenly disappeared, the buying flow that normally meets OTC selling, where the bullion banks play, suddenly disappeared. Okay? The selling still arrived because the OTC market has its own origin order flow, but the buying was not present. So the selling, again, still arrived, but because the OTC market was open, the buying that normally offsets it was unavailable. With no counterparty to absorb the flow across exchanges, prices moved lower. This is
On November 27th, 2024, at 2200 hours Central Time, CME Globex experienced a major outage that shut down futures trading across all asset classes. A cooling failure at the Cyrus One data center halted the platform during Asian trading hours, right after U.S. Thanksgiving, when liquidity was already thin. The timing raised eyebrows. Silver was at all-time highs around $53.82. Platinum surged to $1,641, up $52. Gold traded at $2,674. China had just launched its new platinum futures contract that same day. When Globex went offline, silver sharply reversed, giving back much of its earlier gains. This outage lasted longer than a similar multi-hour disruption in 2019. It revealed three critical issues. First, it exposed vulnerability in the West's most relied-upon electronic trading system, which is supposed to have 3 or 4 fail-safes. Second, it handed competitive advantage to Shanghai exchanges, which are rapidly gaining ground. Third, it demonstrated market fragmentation. When futures went dark, buying flow from the futures side disappeared, but selling in the over-the-counter spot market continued, causing prices to drop sharply. This wasn't just a technical glitch. It exposed how fragile our interconnected global pricing system has become and signals the shift from globalization toward competing regional centers of price discovery. Subscribe to Fine Metals for latest gold and silver market analysis.
Good morning, everyone. I'm Vince Lanci. It's Friday, the day after American Thanksgiving. It's 7:32 a.m., and we're going to do a special market rundown. It's supposed to be off today, but there was some significant news last night that anyone who's waking up after a long holiday dinner might be a little bit surprised by. So the news item, you're looking at the gold spot market on your screen there. The news item is CME Group halted trading across its futures and options markets late Thursday after a data center cooling failure disrupted the CME Globex platform, interrupting live pricing in commodities, treasuries, equity index futures, and foreign exchange during early Asian trading. CME first acknowledged the disruption on November 27th at around 2200 Central Time, reporting that, quote, a cooling issue at Cyrus One data centers had forced a halt of all CME Globex and EBS electronic markets. The issue affected benchmark contracts, including crude oil, gold, the S&P 500 futures, FX pairs, and US treasuries. Futures exchange and the Shanghai Gold Exchange, both separate exchanges tied together, have been gaining ground rapidly in metals. Exchanges today do not simply match trades. They compete for the right to define the price the world references. The old quote, turn the machines back on line from Trading Places is now a real geopolitical business analogy. So beyond the immediate technical failure, there is a strategic business issue. This is the first point. This outage exposes vulnerability, whether the root cause was hardware, software, a vendor problem, or a holiday weekend scenario. The end result is the same. It shows that even the most centralized and respected price engine in the West can go dark. And that is exactly the kind of incident that encourages rival exchanges to accelerate their own ambitions. Any business that depends heavily on its online infrastructure, Amazon, cannot afford downtime. This is not different. CME's electronic platform is the business. When it goes offline, the brand takes a direct hit. In a competitive landscape that now includes rising Asian futures markets, the optics are poor and the timing compounds the problem. It's a narrative that the Western pricing structure is looking increasingly fragile while the Eastern infrastructure is expanding. In that sense, this may be more than just a cooling system failure. It's another sign of a world moving from globalization toward regional realignment and a world where price discovery is no longer defined by a single center, but by competing ones. Mercantile, if you will. There's one final observation from last night that we would like to draw your attention to others. Okay, on the surface, this looks like a straightforward technical failure. Cooling problems happen in data centers. Hardware fails. Software misbehaves. In most industries, that would barely make news, but this is not, quote, most industries. This is CME Globex, one of the most relied upon and redundantly engineered electronic trading systems on the planet. It is supposed to be robust, resilient, and always available. And more importantly, global markets depend on it. Financial markets function because prices are continuously broadcast. When price discovery stops, liquidity quickly becomes illiquidity. Markets seize, information flow slows or fractures. The entire structure of modern globalized trading depends on tight, uninterrupted synchronization. When that breaks, the system stops looking global and starts looking fragmented, which is in many ways a mirror of what's happening in the world right now. CME has only experienced a few major platform failures in the modern era. 2014 and 2019 are the big gan. Precious metals were exceptionally strong. Silver was at all-time highs. Platinum was surging. And on that same day, China launched its new platinum futures contract, which opened strongly and drew considerable attention as new contracts are wont to do. Then, once Globex went offline, silver sharply reversed in the spot market, giving back much of its earlier gains. To traders watching closely, it looked as if the physical market price struggled once its futures contract vanished, exposing how interdependent the two markets have become. One veteran trader put it bluntly, perhaps too bluntly, when he suggested that, quote, someone pulling the plug on the COMEX until they can get that paper book that they have in order, referring, I think, to the rehypothecation cross orders. That's speculation, and it should be treated as such. But it captures a sentiment that arises whenever a key pricing venue fails during critical market moments. You can see what it did to gold. You may not be able to see it here, but because of the rendering, but I'll show you what we're talking about here. Gold, these are 15-minute charts. An hour after, dipped all the way down to here, rebounced, and then retested it. So gold was the most aggressive example of selling that could not find buying. Silver, while it wasn't the most aggressive net, was the most aggressive in the 45 minutes afterwards. So somebody got a bad fill on their selling, or maybe somebody panicked and had to sell and the exchange was closed, so they went to the OTC market. Anyway, I'm Vince Lancy. Have a great day.